What if US stopped paying debt? Will America stop paying the debt? This will have to be done. However, there are reasons why it may not be able to continue that way if it continues along a trajectory where it spends more than it earns each year. US has a debt problem, and it's not even close to being fixed. The country's official debt clock shows the current national debt is over $16 trillion, and it is estimated that the amount owed by the government will exceed 100% of GDP within 20 years unless drastic changes are made. Sovereign default. This happens when the country is unable to pay off its debt, which usually takes the form of bonds. So, if the US defaults, it will essentially stop paying the money it owed US Treasury bondholders. The U.S. national debt reached a record high and exceeded $27.8 trillion in the fourth quarter of 2020. This is more than America's annual economic output as measured by its GDP. What happens in a debt crisis? A true debt crisis occurs when a country is in danger of not meeting its debt obligations. The first sign is when the country finds that it cannot get a lower interest rate from lenders. What could be worse than that? 1. Depression and unemployment. 2. Dollar down, prices and rates up. 3. Minimize your investment. Social Security payments stopped. 5. Banking operational freeze up. 6. Money market fund breaks. 7. Walled in global markets. Will the U.S. ever default on its debt? America has never paid off its debt. The results are unimaginably dire. But in October 2013, Congress pressed for a halt to raising the debt limit, forcing the country into default. It wanted the president to cut investments on Obamacare, Medicare, and Medicaid. The debt limit is how much debt Congress owes to the federal government. If the limit is not raised, the the Treasury Department cannot issue any more Treasury bonds. Its ability to pay bills depends on incoming revenue. It is forced to pay federal employee wages, Social Security benefits, or interest on the national debt. If it doesn't pay interest, the country defaults. How the United States can default on its loans. There are 2 scenarios under which the United States would default on its debt. Not raising the loan limit. Interest rates will rise because the Treasury represents the benchmark lending rate for all other bonds. This means higher costs for corporations, state and local government, mortgage and consumer loans. The dollar would fall as foreign investors fled the safe haven position of the Treasury. The dollar would lose its status as a global world currency. This will have the most devastating long-term effects. Government just stopped paying interest. The second scenario would be when the government simply decided that its debt was too high and stopped paying interest on Treasury bills, notes, and bonds. In that case, the Treasury position on the secondary market would collapse. Impact on economy. A U.S. loan default would significantly increase the cost of doing business. This will increase the cost of borrowing for the firms. They must pay higher interest rates on loans and bonds to compete with the Treasury's higher interest rates. The stock market would also suffer, as any U.S. investment would be risky. Stock prices would fall as investors fled to other countries to save stocks or gold. For these reasons, it could lead to another recession. Effects of coronavirus pandemic. In 2019, the Congressional Budget Office, CBO, predicted a deficit of nearly $900 billion due to government spending and the 2017 tax cuts implemented under the Trump administration. Those projections became even more dire in 2020 due to the coronavirus pandemic. How does the U.S. government pay its bills anyway? Oddly, no one knows how it works. Each day, the U.S. Treasury receives more than 2 million bills from various federal agencies. Debt crisis resolution. Solving the debt crisis is financially easy but politically difficult. Agree to cut investments and raise taxes by the same amount. Each action will reduce the deficit equally, although they have different effects on economic growth and job creation. Tax cuts are not great in job creation. There's no need to create massive debt by cutting taxes. Second, the government can delay any changes for at least a year after the recession. This would allow the economy to recover enough to grow from the 3% to 4% needed to create jobs, which would create the growth in GDP needed to offset any tax hikes and spending cuts. This, in turn, will reduce the debt to GDP ratio significantly to end any debt crisis. That's all for today's video. Thank you for watching. If you enjoyed watching our video, please like and share. Also, don't forget to subscribe and press the bell icon.